Good day, students. This is CMA Mrudula. I'm here for a marathon revision of the subject Financial Accounting, Paper 5 for CMA Inter students. I've started these online series to aid students during the unforeseen COVID-19 situation. So I'll be following Syllabus 2016. The revision video will be divided into 3 to 4 videos of 30 to 40 minutes each because I do not want a single lengthy video. So chapters will be divided accordingly. This video will be useful for CMA Inter students of Syllabus 2016. CA Inter students can also refer to this video. This is recorded for June 2020 Inter exams, but syllabus of accounts does not change much. So if you happen to view this video post June 2020, or if you plan to do so, also it would be applicable. I hope this video will be useful. If you find it helpful and if you like the video, please let me know in the comment boxes below. You can also mail me. The email address will be mentioned in the description of the video. Feedbacks are welcome. Let's begin. We will be covering the first two study notes of financial accounting subject. These are the chapters that we'll be covering the first revision video. Chapter 1.1 Basics, Chapter 1.2 Gap, Chapter 1.3 Accounting Concepts and Conventions, and Chapter 1.5 Accounting for Depreciation will be covered along with the Accounting Standards chapter. These are the remaining chapters in the first two study notes, which will be covered in the first revision video. The first chapter, Capital and Revenue Transactions. It is essential to identify under which category an item or a transaction falls so as to account for it in the correct ledger and to present it in the correct statement in the year end. That is, capital items and transactions would generally go into real account and will be presented in the balance sheet, while revenue items and transactions would generally go into nominal account and would be present in the profit and loss statement. And we know that each statement has a specific purpose. Profit and loss statement purpose is to identify the profit or loss made by the business during the year, and the purpose of balance sheet is to denote the statement of affairs of the business during the year. Let us see the major differences between capital and revenue transactions. Capital transactions are non-recurring, which is it is non-repetitive in nature and it does not occur in the ordinary course of business, whereas revenue items and transactions are repetitive in nature and occurs in ordinary course of business, that is sale and purchase. Capital items or expenditures are mostly related to creation of an asset, that is purchase of an asset, whereas revenue items or transactions mostly deal with maintenance of the asset purchased. So, which is why a capital transaction is a source of income or an expenditure, whereas revenue transactions are the actual flow of the income or expenditure. Capital items and transactions affects the balance sheet, whereas the revenue items and transactions affects the profit and loss account. Capital transactions have long-term benefits, such as purchase of an asset, which gives us benefits for more than 1 year, of course. Revenue transactions have short-term benefits. Say, for example, sale of finished goods gives benefits only for that accounting year, which is why capital transactions are uh, the purpose of investment, whereas revenue transactions and income denotes basically benefits from such investments. An important point to keep in mind is that generally capital expenditure and receipts are of a higher amount or value than the revenue expenditure and receipts, but that cannot be considered as a major differentiation points between both the transactions because it depends on a lot of other factors. The amount depends on a lot of other factors. Another important point to keep in mind is that sale of a capital asset will be reflected in the profit and loss account, though it affects a capital item. Let us look at some examples for both. Examples for capital transactions is purchase of an asset, investment made in FD or shares of another company, shares of own company being subscribed by our shareholders. Examples of revenue transactions are sale of finished goods, purchases of raw materials for manufacturing further, tax payments, salary payments, printing and stationery expenditures, electricity payments, water bill payments, etc. Let's move on to the next chapter, rectification. of errors. Let us understand the importance of this chapter first. So, generally at the year end, while preparation of financial statements, errors in books of accounts will be identified, and that needs to be corrected so that the financial statements will show the correct picture. So let's say the steps of correction or rectification of errors first, and then move on to what are the different types of errors that one could find in the year end. So, what are the general steps? Let us first just understand the steps. So, double-sided errors means errors affecting both the debit and the credit of a transaction. So, the steps to rectify a double-sided error is if the error is identified before preparation of trial balance, then just pass a rectification journal entry because the error had affected both the debit and the credit side. If the error was identified after the preparation of the trial balance, also you can pass a rectification journal entry. It does not affect the financial statements much. If the error is identified post preparation of financial statement, also a rectification journal entry can be passed, but keep in mind that when nominal accounts are rectified at this point of time, open profit and loss adjustment account instead of affecting the nominal account directly, because we know that by preparation of profit and loss account, all the nominal accounts will be closed. Moving on to single-sided errors. Single-sided errors means errors affecting either the debit or the credit of a transaction. So if such errors are identified before the preparation of trial balance, then affect the respective ledger, which is pass the respective amount to that ledger additionally, or add another line item in that specific ledger as required, whether affecting the debit or the credit side. If such errors are identified after trial balance preparation, then a rectification journal entry can be passed. But since there is a single sided error, the other side must get affected to a new account called suspense account, which has to be opened just for rectification of single sided errors. If such single-sided errors are identified post the preparation of financial statement, also a rectification journal entry can be passed, while one side must affect the suspense account. Again, keep in mind that if any nominal accounts are being rectified, open profit and loss adjustment account instead of affecting the nominal account directly, because as we know, all the nominal accounts are closed while profit and loss statement is being prepared. Let us now understand the different types of errors. Error of principle. Error of principle means wrongly treating a revenue item as a capital item or vice versa. That is, wrongly treating a capital item as a revenue item. Which means, for example, a purchase of an asset is being treated as a purchase of a raw material and wrongly accounted in the purchase account, which is a nominal item, which otherwise should have gone into asset account. Okay. So, what is the effect of such error? It will not get reflected in the trial balance because both the debit and the credit side would have been accounted for. So it will not be reflected in the trial balance. Next, error of omission. Error of omission means omitting a transaction completely or partially, which means either you account for only debit side or the credit side and omit it partially. So of course, omitting a transaction completely is a double-sided error and will not be reflected in the trial balance, whereas omitting a transaction partially is a single-sided error and will be reflected in the trial balance. Next, error of commission. Error of commission means passing an entry to the wrong ledger. Okay. So, which, for example, a printing and stationery expenditure is wrongly accounted for in the electricity expenditure account. Okay. So, this also will not be reflected in the trial balance because both the debit and the credit side have been passed. It's just that it is going to a wrong ledger. Next, compensating error, which means any two or more of the errors above may compensate each other so that it will not get reflected in the trial balance. Okay, which means there could be a debit side, partial omission here. At the same time, a credit side partial omission too. So here, two error of omissions could compensate each other. It will not get reflected in the trial balance. There could be other errors such as wrong totaling of ledger accounts, which will affect the trial balance because a wrong amount would go into the trial balance, or posting on the wrong side, that is posting on the debit side instead of credit side. This may or may not reflect on the trial balance because if it is compensating, it will not get reflected in the trial balance, or posting the wrong amount. It could be a single-sided error or a double-sided error, and it may or may not reflect on the trial balance depending on the nature of the debit or credit. If wrong amount is passed only on one side, that is a credit side, then it will get reflected in the trial balance. If the wrong amount is passed as a transaction as a whole, it will not get reflected in the trial balance. Now, what does getting reflected in the trial balance mean? Which means that trial balance will show you the error clearly. Okay, if it shows the error clearly, the trial balance debit and credit side will not tally, which is compulsory required to be done. Trial balance, debit and credit side totals must tally, must match. If it does not match, you cannot move ahead. So only certain types of errors will lead to a mismatch to the debit and credit side. So one more point that you have to keep in mind is that it does not necessarily mean that if the debit and credit side and the trial balance matches, there are absolutely no errors. That is not the conclusion that also that you can make, because certain errors does not get reflected in the trial balance. So which is why you have to keep a double check while posting the entries to the trial balance and while totaling both the points that could be some errors identified. To understand double-sided errors and single-sided errors better, let us take one example. Purchase of an asset. So the correct entry for purchase of an asset would be uh, asset account to bank account. Let us take the amount as 50,000 for this example. If instead of taking the amount as 50,000, we have taken a wrong amount of 40,000, that is an entry saying asset account debit to bank account, both the sides 40,000, 40,000, that is a double-sided error. Another case, where we have not accounted for this entry entirely, that is also double-sided error. Okay, both the cases, both the examples discussed now, taking the amount wrong or entirely omitting the transaction is affecting both the debit and the credit side. So it is a double-sided error. Move on to single-sided error. Now, if again, similarly, instead of taking the amount as 50,000, we are taking the amount as 40,000. But the entry is passed in such a manner. Say asset account debit 50,000 to bank account 40,000. So only the credit entry wrong amount is being passed. That is a single-sided error. Similarly, now while passing the transaction asset account debit to bank account, we have missed to pass the credit entry to bank account. So that is a partial omission. That again is a single-sided error. Let's move on to the next chapter, insurance claim. So this chapter covers the calculation of claim amount receivable from the insurance company during damage of inventory. So this chapter covers insurance taken on inventory of a business and no other insurance, and calculation of the claim amount receivable from the company. The different ways of calculation of the claim amount: loss of profit and loss of stock. Let us first take up loss of profit. So this method considers the profit that will be lost in the future due to the lost or damaged stock. Let us see the various steps involved in calculation of claim amount. Step 1. Identify the indemnity period. Indemnity period covers the period starting from the date of calamity till the date the operations are resumed to normality. It is generally within one financial year. That is called indemnity period or the claim period. Step 2 is to identify the standing charges and differentiate the insured and the uninsured standing charges. Standing charges simply means the indirect expenses that is incurred by the business. Step 3, calculate the agreed GP ratio. The agreed GP ratio is nothing but the net profit of the previous year plus the insured standing charges as determined in step 2, divided by the previous year's turnover into 100. This is a specific GP ratio calculated just for this purpose. Step 3 is calculation of short sales or sales that is lost due to the calamity. So this is a comparison of the turnover of the same period of indemnity period the previous year minus the actual turnover during the indemnity period. Okay, if there are any specific changes in trend of turnover year after year, it will be specifically mentioned in the question, and that effect has to be given in this calculation. Step 5 is to calculate the gross profit on short sales, which is nothing but agreed GP ratio is calculated in step 3 into the short sales calculated in step 4. Step 6 is to calculate the admissible expenses. Admissible expenses means the expenses that is allowed by the insurance company to be claimed. So admissible expenses is whichever of the lower of the below 3. First is actual expenses in the spent in the indemnity period. Second, the gross profit on additional sales, which is also the sales of the indemnity period. Or point number 3, is actual expenses of the indemnity period into the gross profit on annual turnover divided by gross profit on annual turnover plus the uninsured standing charges. Now, annual turnover means the turnover of the period of 12 months working backwards starting on the date of calamity, which means if the calamity had occurred on 5th of May 2012, in the financial year 12-13, annual turnover period would be 11th of May 2012 to 10th of May 2011. Okay, working backwards for a period of 12 months. So, whichever is lower of the three is considered as admissible expenses. Now, step 7 is calculation of loss amount, which is gross profit on short sales, as calculated in step 5, and add the admissible expenses as calculated in step 6, minus any salvaged expenses. Salvaged expenses means any expenses that is saved from getting incurred due to the calamity. Step 8 and finally is to calculate the claim amount. Average class shall be explained little later. So claim amount is equal to the loss amount as calculated in step 7 into the sum insured as given in the policy divided by the gross profit on the annual turnover that is already discussed in step 6. Gross profit on the annual turnover meaning. Let's now move on to the second method of calculation of insurance claim amount, loss of stock. Loss of stock considers the entire value of stock lost due to the calamity. Step 1, calculation of GP ratio based on the previous year. Okay, so previous year GP ratio is taken as it is unless otherwise a change in trend is mentioned in the question. Now, say for example, the GP ratio is given in the question for the previous year as 5%, and additionally a change in trend of say 1% is mentioned. Then you have to recalculate the GP ratio to take into effect the change in trend. That is, the GP amount of the previous year is considered, which may be 10,000 rupees, divided by the turnover of the entire previous year is considered, which could be 1 lakh plus the 1% change in trend effect if it is a positive trend into 100. Okay. Step 2. Calculate the closing stock on date of fire by preparing a memorandum trading account for the period ending on the date of fire from the beginning of that financial year. Say if the fire had occurred on 30th of June 2012, then a memorandum trading account is prepared from 1st of April 2012 to 30th of June 2012. Memorandum trading account is prepared as a trading account is prepared. It is called a memorandum trading account because it is not prepared for the entire year and it is prepared only for a specific period. Step 3. The value of loss of stock is equal to the closing stock on date of fire as determined by preparation of memorandum trading account minus the salvaged value plus the firefighting expenses. Salvaged value is the value of the stock that was saved during the calamity and not being damaged, plus any firefighting expenses that was spent during the calamity. And finally, the claim amount is equal to the loss amount as determined in step 3 into the sum insured as per the policy divided by the closing stock on date of fire. Let us now understand some important terms that is used in this chapter. Say average clause. So average clause is applied in underinsurance policies. What does underinsurance policies mean? Underinsurance policies are those policies where the sum insured in the policy is lower than the sum insurable. Sum insurable is the entire amount that is subject to the calamity and risk of the calamity. In loss of stock method, the amount that is subject to the calamity is the entire closing stock that is available on date of fire. In loss of profit method, the sum insurable or the entire amount that is subject to the calamity is the gross profit on the annual turnover. Okay, so when the sum that is insured in the policy amount is less than the sum insurable, then average clause is applied. Now, according to average clause, the claim amount is always the loss amount that is calculated in the respective method into the sum insured in the policy amount divided by the insurable value, that is the entire amount of risk involved. If the insurable value or the sum insurable is less than the sum that is insured in the policy, then the claim amount is 100% of the loss amount as calculated in the method. Let's move on to the next chapter, Bill of Exchange. Starting from the second slide of the chapter. Yes. So, a bill of exchange is an order drawn and signed by the seller directing a certain person, which is usually the buyer, to pay a certain fixed sum of money on expiry of a certain period of time. So, breaking down the definition, and it is called an order because the seller is ordering the buyer. Okay, it is drawn and signed. That is, it is created and it is also signed and stamped by the seller. So, who creates a bill of exchange? It is always the seller in any transaction. It directs or orders the buyer to pay a fixed amount, which is mentioned in the bill, on expiry or on completion of a specific period that is mentioned in the bill, which could be 3 months, 6 months, or so on. So, bill of exchange will be valid order only when the buyer accepts it. Okay. So, what is the effect when a bill of exchange is created? In seller's books, a buyer is a debtor. On creation of bill of exchange, he transfers the debtor to a bills receivable account. Similarly, in the buyer's books, what happens after he accepts the bill of exchange that is drawn by the seller? In buyer's books, the seller is a creditor. On acceptance of a bill of exchange, that creditor is transferred to a bills payable account. So, in accounting terms, there is not much difference when a bill of exchange is being created by the seller, but in practical terms, a bill of exchange is drawn for the seller to get a surety that on expiry of a certain period of time, the buyer will definitely pay the amount that is mentioned or determined during the transaction between the two. Let us now see how the due date for the buyer to make such a payment to the seller is determined. Now, generally, as discussed, a particular period of time will be mentioned in the bill of exchange, say 3 months or 6 months or 10 weeks. With that information, the due date for the buyer to pay is being determined. So, if the bill type is an on date bill, then the date of drawing plus the bill tenure plus 3 days grace will be the due date. If the bill type is an on site bill, then date of acceptance by the buyer plus the bill tenure plus 3 days grace is the due date. There are certain important points to be kept in mind. The date as calculated above is not there in the month. Say if that happens to be 30th of 31st of April, say for example, if that happens to be 31st of April, then which does not exist in the month, then consider the due date as due date minus 1, okay, which would be then 30th of April. Now, if the due date is calculated as a public holiday, that is, it could be a Sunday or it could fall on 15th of August, which is a public holiday, then consider the due date as calculated minus 1, which is 14th of August. If the due date is calculated and the previous date both are public holidays, then the due date will be equal to due date as calculated plus 1. If the due date as calculated is suddenly declared as a public holiday, then you have to take the due date as calculated plus 1. Please pay attention if the bill tenure is mentioned in days and months. Okay, if the bill tenure mentioned is 30 days, it is different from a bill tenure mentioned as 1 month. If it is mentioned as 30 days, count the number of days. If it is mentioned as 1 month, just take the same date in the next month. Let us understand some important terms that is used in this chapter. Bill discounting. What does bill discounting mean? So, on creation of a bill of exchange by the seller, if the seller is in dire need of funds, the same bill of exchange can be encashed from a bank. This process is called bill discounting. While encashing from the bank the same amount that is mentioned on the bill, a small percentage of the bill amount, which is called discounting charges, is being reduced and withheld by the bank, and the balance is being encashed to the seller. The same amount will be due by the seller on the due date as calculated. That will be settled as the buyer makes the payment to the seller. If the buyer dishonors, the seller himself has to settle the amount with the bank. So, in very simple layman terms, bill discounting is nothing but something like a short-term loan taken by the seller. Let's now move on to the next chapter, consignment. So consignment is a process where the owner of finished goods sends the goods with an agent to make the final sale. Consignment generally happens between manufacturers and wholesalers. That is, manufacturer being the owner of the finished goods sends goods through an agent to make sales to the wholesalers. So here, the owner is called the final seller, is called the consignor, who is also called the principal. The agent is called the consignee. The consignee receives an amount of commission for making such sales. Generally, agent is only responsible for making the final sales and giving back the amount so received on such sales to the principal. In certain contracts of consignment called the DCC, Del Credar Commission contracts, the consignee takes additional responsibilities such as risk of bad debts, which means he is responsible for collection of any bad debts as well, and he also takes the burden of bad debts on him. In such cases, additional commission is paid to the consignee. So the consignor opens a consignment account, a consignee account, and in non-DCC contracts, consignment debtors account. Because in DCC contracts, consignee takes responsibility of consignment debtors, as you can see here. Consignee opens a consignor account and a commission account. In DCC contracts, consignment debtors account as well. A lot of times this doubt arises in the mind of students, which is, isn't transfer of the final goods by the consignor to the consignee amount to a sale? Let us discuss that a little in detail in this video. Let us first understand what a sale in accounting terms means. Sale is complete and is accounted for only when risk, rewards, and ownership of the goods is transferred to the final buyer. Now, there are different types of sales. So, in each type of sale, the timing of such a transfer of risk, rewards, and ownership to the buyer happens to be different points of time. In CIF sales, CIF means cash, insurance, and freight. The point when the risk, rewards, and ownership is transferred to the customer is when the goods reach the customer's location. In FOB sales, that is freight on board sales, the point of transfer of risk, rewards, and ownership to the customer is when the goods have been sent out of the seller's godown for transportation to the buyer. In over-the-counter sales, that is sales that happens in shops, standalone shops and malls, the point of transfer of risk, rewards, and ownership is when the final payment is made and the possession is taken by the customer. Only in such cases a sale is considered complete. Now, in cases where the consignor transfers or sends goods to the consignee, risk, rewards, and ownership of the goods is not transferred to the consignee, and hence that transfer is not considered as sale. But in insurance claim chapter, while preparation of memorandum trading account, stock with consignee is also added to the sales amount. This is done to obtain the correct value of stock in hand on date of fire and does not mean anything else. This is specific only to the insurance claim chapter, and otherwise the stock with consignee is added to closing stock and not to sales. Let's move on to the next chapter, joint venture. Joint venture is a temporary arrangement where two or more companies get together for a particular purpose and a particular period of time. Joint venture is also given a separate name. Examples of joint venture: Bangalore International Airport Limited. Okay, it is a joint venture of three entities: Siemens Project Ventures, Fairfax India Holdings Corporation, and the Airport Authorities of India, and Karnataka State Industrial and Infrastructural Development Corporation. There is a small typing error. It is 4 entities and not 3 entities. And this joint venture is created for a specific purpose of constructing, maintaining, and operating the airport. Another example of a joint venture is Maruti Suzuki. Suzuki Motor Corporation, which is a Japanese automobile company, came together with Maruti Udyog Limited, which is an Indian automobile company, okay, to form a joint venture called Maruti Suzuki to aid Maruti to import Suzuki parts for cars, because Suzuki parts are definitely of a better quality, and they also aided Maruti Udyog Limited in automobile manufacturing. Though this joint venture lasted only till 2013, and post that Suzuki bought more controlling stake in the joint venture and floated it as a subsidiary of Suzuki called Maruti Suzuki India Limited. In this chapter, a doubt generally arises among students, which is the difference between merger and amalgamations and joint venture. Let us first clearly understand that a merger or amalgamation is where a company purchases stake in an existing company and makes it a part of its same group. So it comes under the same group, and it is almost considered as the same company. Whereas joint venture is a temporary arrangement among two or more companies coming together for a particular purpose. Okay, there is no controlling stake of the other company owned by the co-venturers, which means the co-venturers do not own controlling stake of each other. So here we finish the revision video part 1. The rest of the chapters will be covered in the coming 2 to 3 videos. So here we come to an end of revision video 1. We've covered the first 2 study notes of financial accounting. I hope this video is useful for Inter students. Please let me know the feedbacks in the comment boxes below. Can also be mailed to me. The email address is mentioned in the description below the video. If you want any particular detailed video of any particular chapter or topic of financial accounting, please let me know in the comment boxes below, or you can also mail it to me in the mentioned email address. Thank you, all the best, and please take care given the current situation.